Okay, so you want to own OpenAI. Back the most talked about company in the world, sit at the center of the artificial intelligence revolution, and watch the future arrive with your name on the cap table. That's the picture, and it's an intoxicating one. Read any headline from the last 2 years, and it looks like the easiest bet ever assembled. Every major corporation is signing deals, every government is paying attention, every competitor is scrambling to catch up. You watch that and you think, whoever owns a piece of this is holding the most valuable asset in the history of technology. Here's the problem. You're looking at the press coverage and mistaking it for the business. The truth is that OpenAI is not really an AI company. It is an infrastructure consumption machine that happens to produce intelligence. And the moment you understand that difference, everything about how OpenAI makes money and how it quietly spends extraordinary amounts of it starts to make sense. Let's start with what this company actually is, because the label AI company is doing a tremendous amount of misleading work here. OpenAI does not sell artificial intelligence. It sells access to the output of artificial intelligence, responses, completions, images, code, delivered through an API or a consumer product, billed by the unit, at a price that has been falling consistently since the day the first model launched. The thing it actually owns, the trained models sitting on its servers, cost hundreds of millions of dollars to produce and begin depreciating the moment a competitor releases something comparable. And in this industry, competitors release something comparable with a regularity that would be alarming in any other business. Now, here's where the structure gets interesting. OpenAI was founded in 2015 as a nonprofit. That original structure was not a tax decision. It was a philosophical one, a group of researchers who believed artificial general intelligence was coming, and that the entity building it should not be answerable to shareholders trying to maximize a quarterly number. That founding premise lasted approximately 3 years before the practical reality of the cost of training frontier AI models made the nonprofit structure functionally untenable. You cannot raise the kind of capital required to train GPT-4 from charitable donations. You need investors, and investors need a return. So, in 2019, OpenAI created a structure it called a capped profit company, a for-profit subsidiary sitting underneath a nonprofit parent, with investor returns limited to a multiple of their original investment, rather than uncapped equity upside. Microsoft came in with $1 billion under that structure. Then more capital. Then more still. By early 2025, OpenAI had raised roughly $40 billion in its most recent funding round at a valuation of $300 billion, making it the most valuable private company in the world by a significant margin. Read that again, a company that has never posted an annual profit, that was structurally reorganizing its legal entity even as the round was closing, that operates in a market where its core product gets cheaper every quarter, was valued at $300 billion, not because of what it earns, because of what investors believe it will eventually earn in a future that has not arrived yet, in a market whose shape nobody can fully predict. That gap between the valuation and the earnings is the entire story of this business. Here's where the naive mental model collapses entirely. Training a frontier AI model is not a one-time cost. It is not like building a factory that then produces goods indefinitely. Every new generation of model requires a new training run. GPT-4 was estimated to have cost somewhere between $50 million and $100 million to train. That figure is almost certainly understated when you account for the full infrastructure, the failed runs, the research labor, and the compute time spent on experiments that never shipped. The models that follow it cost more. The compute required to stay at the frontier scales faster than the revenue generated by the previous generation. And then there is inference. Inference is what happens every time someone sends a message to ChatGPT and receives a reply. The model does not retrieve a stored answer. It generates a response, token by token, using GPU compute in real time. Every conversation costs money. Every API call costs money. The cost per query has fallen dramatically as hardware has improved, and as OpenAI has gotten more efficient at running its models, but the volume of queries has grown faster than the cost per query has fallen. The net result is that serving its existing users is one of OpenAI's largest and most relentlessly growing expenses. SoftBank, one of OpenAI's largest recent investors, has committed to building out data center capacity alongside the Stargate project, a joint infrastructure initiative with Oracle and other partners, with total projected spending in the hundreds of billions of dollars over the next 4 years. This is not an engineering project. It is the physical expression of a bet that the compute required to run and train frontier AI models will be so large and so difficult to access that controlling that infrastructure becomes a strategic moat in itself. Whether that bet is correct is the central question underneath every investment thesis in this entire industry. Now, let's talk about revenue. Because OpenAI does have real revenue, and it is growing fast, OpenAI generated approximately $3.7 billion in revenue in 2024. By early 2025, the company was reporting annualized revenue of around $12 billion, suggesting a growth rate that almost no company at that scale has ever sustained. ChatGPT has over 300 million weekly active users. The enterprise business, selling API access and custom deployments to corporations, is growing faster than the consumer side. The $20 per month ChatGPT Plus subscription has millions of paying subscribers. The $200 per month Pro tier exists and has customers. These are real numbers. Here's the structural problem sitting underneath them. OpenAI was reportedly losing approximately $5 billion in 2024 on that $3.7 billion in revenue. The losses are not a rounding error, they are larger than the revenue. For every dollar OpenAI brought in, it spent roughly $2.40 getting it. The gap is closing. Revenue is growing faster than losses, but the underlying cost structure of this business is unlike almost anything in the technology industry's recent history, including the years when Amazon was building AWS and losing money doing it. The comparison to Amazon is one that OpenAI's investors reach for frequently. Amazon lost money for years while building the infrastructure that eventually became the most profitable cloud business on the planet. The argument is that OpenAI is doing the same thing, spending aggressively now to build a position that will be enormously profitable once the infrastructure is in place and the market is mature. Here's the honest version of that argument. Amazon was building warehouses, logistics networks, and data centers, physical assets that retained value, that could be repurposed, that generated predictable returns as utilization rose. OpenAI is training models that become partially obsolete every 18 months, running on rented compute from Microsoft's Azure infrastructure, in a market where the price of its primary product declines every quarter as competition intensifies. The assets are different. The depreciation curves are different. The analogy is more comforting than it is accurate. This is not a criticism of OpenAI, it is a description of the actual shape of the business. Now, here's the piece that almost nobody discusses when they look at OpenAI's competitive position. The thing that makes ChatGPT feel irreplaceable to its users is not proprietary in the way a patent is proprietary. The large language model architecture that underlies every frontier AI system, the transformer, the attention mechanism, the training methodology, was published openly in academic papers. Google published the foundational transformer paper in 2017. The research that makes these models work is, in its underlying form, available to anyone with the compute to use it. What OpenAI has that its competitors do not is a head start, a brand, a distribution advantage through the Microsoft partnership, and a research team that has repeatedly demonstrated the ability to push capabilities forward faster than the field expected. Those are real advantages. They are also the kinds of advantages that erode over time in a market where every major technology company in the world, Google, Meta, Amazon, Microsoft itself, Anthropic, Mistral, dozens of others, is spending aggressively to close the gap. Meta released its Llama models as open source, meaning any company, any developer, any government can download a capable large language model and run it themselves, for free, without paying OpenAI $1. The existence of capable open source models does not make OpenAI irrelevant, but it permanently caps the price ceiling of what OpenAI can charge for API access, because the alternative, running your own model on your own infrastructure, becomes more viable every quarter. Here's where the legal structure becomes just as important as the technology. In late 2024 and into 2025, OpenAI began the process of converting from its capped profit structure to a more conventional for-profit corporation. The stated reason was access to capital markets. A traditional for-profit structure makes it easier to raise equity, issue stock to employees, and eventually pursue a public offering. The practical tension underneath that conversion is significant. The nonprofit parent of OpenAI was supposed to retain control of the mission, the commitment to ensuring artificial general intelligence benefits humanity broadly, rather than a narrow set of shareholders. Converting to a for-profit structure, even with stated commitments to that mission, shifts the center of gravity toward the investors and away from the founding philosophy. Elon Musk, one of OpenAI's co-founders who departed from its board in 2018, filed legal challenges attempting to block the conversion, arguing it represented a betrayal of the original nonprofit compact. The litigation is ongoing as of mid-2025. Its outcome will determine something more fundamental than a corporate structure. It will determine who OpenAI is actually answerable to. That is not a minor governance detail. It is the question that sits underneath every other question about this business. Now, let's talk about the regulatory layer, because it is heavier here than in almost any other industry. The European Union's AI Act, which came into force in 2024, creates tiered obligations for AI systems based on their assessed risk level. Frontier models like GPT-4 and its successors fall into the highest tier of scrutiny, requiring transparency about training data, model capabilities, and safety testing before deployment. Compliance is not optional, and it is not cheap. Every new model release in Europe requires documentation, assessment, and ongoing monitoring that adds cost and time to the development cycle. In the United States, the regulatory environment is less codified, but no less consequential. Congressional attention to AI safety, data privacy, and the use of copyrighted material in training data has resulted in a persistent legal overhang across the industry. The New York Times sued OpenAI and Microsoft in late 2023, alleging that training data included copyrighted journalism without licensing or compensation. That case is still working through the courts. If it, or the dozens of similar suits filed by authors, artists, and publishers, results in a requirement to license training data retroactively or prospectively, the cost structure of building frontier models changes dramatically. These are not exotic tail risks. They are the normal operating environment of a company at the center of the most consequential technology debate of the current decade. So here's the math in plain mechanical terms. OpenAI's path to profitability runs through one of two mechanisms. Either revenue per user rises fast enough, and cost per query falls fast enough, that the gap between what comes in and what goes out closes before the capital runs out. Or, OpenAI finds a second revenue architecture, enterprise software, licensing, government contracts, a hardware play that generates margins meaningfully higher than API access at declining prices. The company is pursuing both simultaneously. The enterprise push is real and growing. The rumored hardware initiative, building custom AI chips to reduce dependence on NVIDIA's GPUs, which currently represent one of the largest single-cost inputs in the entire operation, is the kind of vertical integration that, if successful, could structurally lower the cost floor of running models at scale. NVIDIA's H100 GPUs sell for tens of thousands of dollars each. A data center running frontier AI inference needs tens of thousands of them. Owning the chip design changes the economics of that equation in ways that compound over years. But custom chip programs take years to produce results, cost billions to develop, and carry significant execution risk. Google has been building its own TPUs for over a decade and still buys NVIDIA GPUs. Apple spent years building the M-series chips before they delivered their full cost advantage. The payoff is real, the timeline is long, and the path is uncertain. Now, the two scenarios, because this is where the picture splits. In the optimistic scenario, GPT-5 and its successors maintain a capability lead over the competition that is large enough and durable enough that enterprises continue paying premium prices for OpenAI's API rather than switching to cheaper alternatives. The consumer subscription base grows as ChatGPT becomes a genuine productivity tool for a broad population, not just early adopters. Revenue crosses $25 billion by 2026. Custom chips reduce inference costs materially. The corporate conversion completes cleanly, a public offering follows, and the valuation, which today is supported entirely by private market faith, acquires the earnings foundation it currently lacks. The Amazon analogy turns out to be correct. In the realistic scenario, the capability gap between OpenAI and its competitors narrows faster than the optimistic projections assumed. Enterprise customers, who are sophisticated buyers with procurement teams actively evaluating alternatives, begin substituting cheaper models for lower-stakes workloads, the majority of actual enterprise AI usage, while reserving OpenAI for only the highest complexity tasks. Revenue per API call continues declining. The custom chip program takes longer than expected. The legal structure conversion attracts enough litigation to delay the public offering. Losses narrow more slowly than the market priced in at the $300 billion valuation. The stock, when it eventually lists, re-rates to reflect the actual pace of progress rather than the projected ceiling. Neither scenario requires a collapse. OpenAI has real revenue, real users, real strategic partnerships, and more capital than almost any private company has ever held. It is not going anywhere quickly, but it is also a company valued at $300 billion that lost more money than it made in its most recent fiscal year, in a market where its core product gets cheaper every quarter, where its foundational research is publicly available, where every major technology company on Earth is its direct competitor, and where the legal and regulatory environment is moving in directions that add cost and uncertainty to the one thing it does that nobody else does quite as well. So, if you decide you want to own OpenAI, remember the one thing that actually determines whether that bet ever makes sense. It was never really about whether the technology works. The technology works. It's about whether the company sitting on top of that technology can build something durable enough and profitable enough before the rest of the world catches up to what it figured out first.